bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the April 22nd, 2025 episode. My guest this week, as those on YouTube can see, is Thomas Stagg. Thomas is a partner of mine based in our Seattle Metro office. Thomas is Novogradac's leading expert on income and derivatively rent limits for affordable housing properties, which makes him a great guest for today's topic. Now, as our longtime viewers and listeners know, there are not many people outside of the U.S. Department of Housing and Development, or HUD, who know more about income and derivatively rent limits than my partner, Thomas. Thomas is on the program today because on April 1st, HUD did release income limits for fiscal year 2025. We were wondering if they would meet that date, and we were told they were likely to meet that date, but you never know with a new administration and the like, so we were very pleased to see the income limits coming out on April 1st. Now, these limits determine the eligibility for HUD-assisted programs and low-income housing tax credit properties. These income limits are also used derivatively to calculate rent limits for many affordable housing properties, most notably properties financed by low-income housing tax credits. And let me just emphasize the point, HUD releases income limits. Those income limits are then used by practitioners like us to calculate the rent limits that can be charged. Now, the big news this year with this release is that the average, and by average, I mean the mean, not the median, the mean annual change in HUD's limits across all areas was an increase of 6.2% over the 2024 income limits. Now, I mentioned it's a 6.2% is the mean. If you looked at the median is 6.35%, which means, more than half of the areas have an increase of 6.35% or more. Now, obviously, based upon that being the median, the per property results will vary. So I'm sure many in our audience are saying, well, on a particular property, ours was much lower than that or much higher or about that. Now, this year, the cap on income limit increases for 2025 was 9.2%. Many in our audience may remember that last year HUD created this 10% overall cap. And if the income limit increase was capped at 9.2%, then obviously that overall cap of 10% didn't kick in, but it is still part of the rule. I'll also note that this overall cap of 9.2% doesn't apply for a subcategory of properties known as HERA or HERA specials, but I'm not going to go into that in my introduction. If Thomas wants to discuss that in the course of the podcast, he's free to do that. And obviously, when I mentioned 6.2% is the mean increase in income limits and 6.35% being the median in the change in rent limits, or I should say 6.35% being the median in the change in income limits, both the 6.2 and 6.35 derivatively apply to the rent limits. I'll also note that since the limits were announced on April 1st, they must be implemented by May 16th. Many clients will end up waiting to implement them. Others might implement them right away. And there's a variety of factors why different individual properties will implement them sooner or later, but there is this 45-day grace period. In terms of key takeaways from this year's income limits announcement, preparing for the podcast, Thomas and I focused on 3 key takeaways. The first one, as I already mentioned, is the income limits were higher than anticipated, and we will discuss why they were higher than anticipated. Second, every year clients were asking us about the number of areas that were capped, and this last year would have been capped at 10%. This year was capped at 9.2%, and we will discuss the number of areas that were capped. And then third, it's somewhat more minor in that roughly 50 areas had their area definitions changed. And I say it's somewhat minor unless you're one of those 50 areas. It's very major. And Connecticut was particularly affected by area definition changes. So as you can tell, there's a lot we're going to want to discuss today. So whether or not you're a property manager, developer, investor, syndicate, or lender, or other working in affordable rental housing, this is a podcast that you'll be very interested in. Also, before we get to Thomas as our guest, I want to remind everyone we do have our next affordable housing conference, May 8th and 9th in San Francisco. And certainly income and rent limits will be one of the many topics that we discuss. And if you want to get more information about the upcoming conference, please visit our website at novoco.com, novoco.com. And I'd also encourage you, if you're not already a member of the income limits working group that Thomas leads at Novogradac, to consider joining. And in the course of the podcast, Thomas will also talk about the Novogradac rent and income limit calculator, as well as the rent and income limit estimator, which I'd encourage you to become a client of as well. So now let's get back to today's episode. Thomas and I have a lot to discuss. So if you're ready, let's get started. Thomas, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's good to be back.
So this is your 15th appearance on Tax Credit Tuesday, which does make you one of our most frequent guests. Only 3 of our fellow partners have been on the program more than you. One is Tony Grapponi, but since he's a regular feature of our real estate finance series, that's not a surprise. And then the other would be Peter Lawrence and Brad Elphick. But for members of our audience who aren't familiar with you, based upon your prior 14 appearances, please describe the services, or at least some of the services. We only have so much time. Some of the services you provide to Novogradac clients.
Yeah, it's funny. When income limits come out, I kind of feel like Mariah Carey at Christmas. Everybody wants to talk to me at that point of the year, but then maybe not the rest of the year. I was kidding. So I work a lot with developers that are using low-income housing tax credits and tax-exempt bonds to build affordable housing. And so really work kind of soup to nuts with them. I help them with application work, applying for tax credits, applying for other federal or state funding, and then obviously doing the audit and tax work on those entities all the way through year 15, and then help with year 15 exits as well. So if you're a developer, I'd love to talk to you, and I'm sure that there's a way that we could work together.
Great. Thank you for that, Thomas. Now, maybe before we get into some of the key takeaways, if you could maybe level set and share your thoughts and insights about this year's income limits and derivatively the rent limits, and we'll get into some of the more specific questions.
Yeah. So as you mentioned, the lead-in, income limits are up across the board. Over 71% of areas had an increase of greater than 5%. I always like to look at that 5% mark because that means you're kind of doing probably double what you were underwritten at. We usually underwrite between 2 and 3% for income and rent increases in our pro forma. So if we're getting above 5%, we're doing really well. But this year was actually even better than that because 41% of areas had an increase of over 8%. And we mentioned the caps. And the cap, as you mentioned, is 9.23%. And so 27% or almost 27% of areas had their increase capped. So we're talking very, very strong increases this year. And this is generally good news. It's good news for prospective tenants, as higher income limits allow more people to qualify. It's good news for projects that are placing in service, right? As these higher rents will help support additional debt, help cover potential cost overruns, help cover more expensive debt. But we also have to be careful here because it can mean increased rents for existing tenants. And so owners always want to be mindful of how they're implementing the new limits on existing tenants and look at their portfolio, making sure they're thinking about that and thinking about, do I phase this in over time and how to do this increase? But it's not all only good news. About 5% of the areas actually had a decrease in their income limits this year. We talk a lot about the cap, but there's also a floor. And about 1.5% of areas had a decrease that was subject to that floor. Now, if you're in service, you're held harmless. And so you don't actually decrease your income or rent limits. You get to maintain at the level you're at. But being held harmless isn't actually great news because it doesn't somehow hold harmless your expenses or anything else. And so those projects do feel pressure, especially if they're held harmless for multiple years. And so understanding if you're in an area that had a decrease, especially one that was floored, understanding what that floor was and how long it looks like you might be having decreases can be helpful for your project to understand.
I appreciate you pointing out the hold harmless. And not only does it not address your expenses, to the extent utility allowances are changing. It's the gross rent that's held harmless, not the net rent. So there can actually be slight decreases in rent. So I just want to note that because, some people will take it as if that means the rent's not going to go down, which isn't necessarily the case depending upon your utility allowances and that adjustment. When you look at the geographic areas, you say there were some that were subject to the floor. What geographic areas of note, had experienced the decreases and or rose most significantly?
Yeah, so let's talk about the increases first. So we had quite a few areas that had large increases. And when we look at high population cities, a lot of those were actually all the way up at the cap. So Los Angeles, Phoenix, San Diego, Miami, Riverside, Fort Lauderdale. Some of these really large cities were cities that were capped at 9.23%. And so that had a big impact on the income limits. And kind of speaking of these capped areas, some of them had very meaningful caps. We look at an area like Santa Cruz, California, that if we didn't have a cap, their income limit would have increased by 35% this year.
35%.
Right.
Wow.
I know. I was quite surprised about that too, because Santa Cruz has had a couple of years of kind of rapid increases. And so obviously there's no world where we'd want to be increasing rents by 35% on tenants, but that does make it harder, I think, to qualify people there if we think that's what's really happening with income limits. Another large area that was impacted is Tampa, St. Petersburg, and that would have risen by 20% but for the cap. So we had some kind of big areas that had this cap. And if we look at notable cities with decreases, there weren't so many large cities. San Francisco had a very kind of modest decrease of 1%. There are a few other cities across the country, but our large population cities tended to do very well this year with larger increases.
Great. Thank you for that. It's when you mentioned the 35% increase in Santa Cruz, it definitely, creates a backlog or some support for future increases, which makes underwriting new transactions in that area interesting.
Right.
To say the least. There's how conservative or aggressive you want to be in terms of underwriting rent and income limits going into the future. So you mentioned that the income limits are up more than anticipated, and you do great work with the rent and income estimator, where we try to estimate the various increases based upon the guidance that HUD gives us. So the fact that they were up more than we anticipated, it basically means that HUD changed their calculation formula in some way. So if you could explain that, I'd appreciate it. I know the audience would appreciate it.
Yeah, it did catch us by surprise that HUD had changed their inflation factor. So let's first talk about what the inflation factor is and what it does. So when HUD's calculating income limits, they need to use some sort of data source to use their baseline for this. And for that, they use the American Community Survey, which somebody at the Census Bureau would not like this analogy, but I call it a census light. So instead of that census happens every 10 years where everybody responds, this is a survey that happens every year. And they send out a bunch of surveys and people respond to those surveys. And that's American Community Survey. And in there's income information. So HUD uses the most recent American Community Survey, but because that survey is taken throughout the entire year and there's survey packets sent out every month for the year, the last survey for 2023 is actually sent out in December or January, and the people have 90 days or longer to respond to that. So the American Community Survey, the responses aren't even back until, for 2023, aren't even back till April of 2024. And then Census has to process all that information. And so the 2023 data doesn't get released till September of 2024 for the 1-year data and December for the 5-year data. And so HUD takes that data and actually does a pretty good job of turning around income limits pretty quickly because they get in December and release their limits in April. So this is the most current data they can use, but it's 2023 data. So it's historic. So they have to somehow take this historic data and trend it forward to 2025. And so they use what we call a trend factor and inflation factor. And for the last few years, they've been using a CPI inflation factor, consumer price index. But HUD's done a lot of work to kind of look back and say, has that inflation factor been accurate? Because we know we do the inflation factor, but 2 years later, we know what the actual answer is. So we know how well of a job they did at estimating it. And so they've gone back and tracked this. And what they found is that with CPI, CPI moves earlier than income limits. So if you're using a CPI trend factor, when the economy turns up, you actually end up overestimating income for a couple years, and then wages generally catch up, then you're fine. And then when the economy slows down, CPI slows down first. And so then you underestimate income limits for a couple years, then wages kind of catch up to that or decline down to that. I'm not sure what the right word is there because it's still higher, but a slower rate of growth. And so they've kind of been wanting to move away from a CPI index. And so when they were looking, they came upon, obviously they have all this data, and they settled on the per capita wages and salary data. And this is a Congressional Budget Office product. And so basically what they do is they take the per capita wages and salaries for 2023 and see how much that's grown to 2025. And that's what they use as their trend factor now. And so now that it's tied to wages, HUD's hopeful that it will better match the curve, and we won't have kind of these gaps when they've overestimated incomes or underestimated incomes. Now, HUD was first to admit that, yeah, this worked better in the past, but doesn't always mean it's going to work better in the future.
Right.
But they were very thoughtful, I think, with this change. And the change is interesting because right now we are in a little bit of a slowdown with CPI. And so the old trend factor would have been about 1.04, which means over 2 years, an average increase of about 2%. But the wages trend factor came out at 1.08, which means, again, over 2 years, roughly a 4% increase each year. And so if we just look at what this impact has had on income limits, it makes sense that the higher trend factor is going to end up with higher income limits, right? So we have a $50,000 ACS estimate and our trend factor is 4%, we're going to end up at a $52,000 estimate. If your trend factor is 8%, you're going to end up in a $54,000 estimate. And so this higher trend factor resulted in a direct and immediate increase in area median income of about 3% higher. And this is totally in line with what we estimated. We estimated that we're going to see about a 3% increase. We end up with a 6.2. It's because the trend factor they used was higher. Now, we'll talk about this more at the end. We are kind of coming into where CBO is forecasting that wages are going to start to slow down their growth. So we are seeing we're going to have a slower trend factor next year. So that's something you start considering when we start looking at 2026 with our income limit outlook about these trend factors. But to kind of get back to your question, because the trend factor was higher, we end up with these higher income limits. And again, we think that this is good because it's matching more with what we think is changing in wages. So I like this change by HUD. I think it's a good change. I wish they would have, and they've been so good about this lately with fair market rents and other things have been changing. I wish they would have signaled to the industry ahead of time they're making this change and taken feedback. But they've been so good about that lately. I think we've been spoiled. So it caught us a little bit by surprise.
No, I appreciate that. It definitely would have been nice to know in advance.
Yeah.
But you mentioned earlier that roughly, if I remember correctly, 25% of the areas were capped. Roughly a quarter of the areas were capped. Any additional information that you want to share beyond that in terms of more of the you talked a little bit about some of the areas like Santa Cruz and other areas in Florida that would have been dramatically higher.
Yeah. So I think the first interesting thing is talk about, well, how did we come up with this 9.2%? Why is this our cap? And longtime listeners have heard us talk a lot about the cap. So I won't go into the full detail, but the cap is basically 2 times the change in national median income. And HUD wants to use that to kind of smooth the increase. And so we had a cap of 9.2, but as we saw, we had a very strong inflation factor. And so when you compound that inflation factor and still strong ACS growth, we had a lot of areas that had very, very strong growth in their income limits. And HUD doesn't want to have large swings from year to year. And so they were capped. And I think initially, if we look back when the cap first started, it was really to catch outliers that were increasing kind of not in step with everybody else. But with this new cap, especially when we have, because that's calculated using historic data and this ceiling at 10%, we definitely see many more areas caught by the cap right now. So the fact that 27% of areas are capped is a lot of areas. But let's talk about what that cap means. And you kind of hinted at when we talk about Santa Cruz is often it means that we have some kind of pent up increases that we can use in future years. We looked at in the podcast we did last week, we looked at an area where basically it had been capped for the last 5 years. And so VLI was growing, and eventually that was closing up because the AMI had grown a lot in the early years, and then the growth was slowing. But then every year, the VLI was growing at the cap and catching up to it. And so in some ways, ideally, it serves to kind of smooth out the increases over time and serves kind of as a piggy bank you tap into, so you're able to kind of have this nice steady growth. But sometimes that's not true. Sometimes we see areas where this growth was maybe an anomaly in the survey data, or something changed in the environment. And so we have this big increase, it's capped, and then the following year, the factors fall. And now we have an income limit that's lower than the following year, and we never get that cap. We never get to go up to that kind of lost amount. And so just because an area is capped doesn't mean it's guaranteed an increase in the following year. I usually say we got to understand the area. We need to look and say, well, what was the difference between the published and the capped amount? That bigger the spread, the more likely you're going to have big increases, right? Not guaranteed, but more likely. But if that spread is $1, I guess they round to $50, is $50, well, probably not going to have a big impact in the next year. So not all capped areas are created equal. So kind of understanding the dynamic of the cap and that spread is important to understand if you're kind of looking at a new project and saying, hey, I'm in Santa Cruz, we've had 35% increases. Does that mean I'm going to be capped for the next 6 years? Well, probably, because Santa Cruz has been capped for the last 3 years, right? So that tells me good news. But if it's an area where there's not much difference, then you're really probably going to dig in deeper and look at this and do more analysis on it.
Thank you for that. And I would note your observation about eligible tenants in these capped areas is sort of a meaningful observation. All your observations are meaningful, but I find that one particularly sort of insightful in the sense that from an underwriting perspective going forward, you can look at that area and say it should have positive rent growth to deal with higher construction costs, higher operating expenses, and the like. The flip side is when you go to Novogradac market study, you need to ensure that you have enough eligible tenants that are in that band of eligibility and can afford to pay the restricted rents. That part of it becomes a little bit more of a challenge from the standpoint of underwriting. So,
And I think the third point on underwriting is, are these rents achievable? Right? We always talk about the rent limit going up by
yes,
10%, but we always have to say, well, but is that achievable rent for your market? And it isn't always, even in these strong increased markets. So there's a lot to think about on that underwriting side. Maybe that will be my 16th or 17th podcast. We can talk about underwriting.
We will have you back. I think our audience might enjoy a podcast with you focused on underwriting. So in terms of when I was doing the intro, I did talk about the redefinition of some of the geographic areas. And as I noted in the introduction, at first, this redefinition question was like, wow, how dramatic is this? And a lot of sort of interest among our developer and syndicator and investor base in terms of how broad are these definitions. And as we discussed in prep of the podcast, roughly 50 plus or minus did see definition changes, which obviously if you're not in those areas, then it's not that relevant. But obviously if you're in those areas, it becomes existential. So please share for our audience at a high level what generated the change and any other insights you wanted to share with respect to the areas that were changed.
Yeah. So first, we need to start with understanding that HUD follows, for the most part, the Office of Management and Budget's area definitions. So their Office of Management and Budget, OMB, they determine what's an MSA. And so when they say this is an MSA, HUD says, okay, this is an MSA. We're going to follow their definition. Now, sometimes HUD will carve off special areas and things like that it's probably outside the scope of this podcast. But so HUD was conforming to the OMB definitions. And now if we look at this, there were 200 areas that just had a name change. So OMB changed the name of the MSA from, Hampton West to Hampton MSA, for example. That's not a real example, but that's kind of what we see, just these simple name changes. And so those we don't need to worry about at all. I think when people saw this, they got really scared that, oh my goodness, all my areas are going to change. No, we had 200 that had name change only. And then that means we had 2,400 that had no change at all. And then we had these 40 you talked about. There are 40 plus 50-ish that you talked about. And 42 of those are in Connecticut. We'll talk about Connecticut second. The other are kind of spread across the country. And what it is where largely where we had an MSA that had an area that became so that was now non-metro and was no longer part of that MSA. So it dropped off from the MSA. And so in 2024, its income limit was published based on the entire MSA. All the areas that had MSA, we took all the American Community Survey data for that whole MSA and calculated the median. But now that that area has fallen off of that area gets its income limits calculated based only on the survey responses for that area. And then the surviving MSA, if you will, gets its income limits calculated on all the respondents for everything that's in that current MSA now. And we see that that can actually have a big impact on income limits. I'll just give one example here. One is Pine Bluff, Arkansas MSA. It was a 3-county MSA. And after this area definition, now each of those, basically the MSA went away for all intents and purposes. And so Cleveland County was the most wealthy of the counties just based on the income limit data. And so when it was split off of the MSA, it saw a huge increase. It actually increased all the way up to the cap at 9.2%. But then Jefferson and Lincoln counties, who were kind of the not as wealthy counties in the MSA, their income limits had just a very minor increase at around 1% increase. And so we see that when you're split off, you have to understand, what are you split off of? And you're kind of benchmarked off of this combined one, and now you're off on your own. And we have a great blog post that looks at these 10 or so areas that this happened to. And you can see kind of when they split off, who went up, who went down, and kind of what happened there. But then we have Connecticut. And Connecticut's a whole nother animal, and we'll talk about this quickly. Again, you can read the blog post for more details or come talk to me. But in Connecticut, a few years ago, they had a vote that changed basically how they were going to do what we would call counties. Connecticut calls them planning areas. And so they changed Connecticut itself. The legislature changed how they were defining county equivalents in Connecticut. And once that passed, then OMB implemented that change. And then when OMB implemented that change, HUD also implemented that change. And that caused for an income limit world widespread pandemonium, if you will, because now we have these areas that were all kind of drawn and they all got redrawn. And we have people coming from this area into this area with these 5, it used to be these 6. And so this 169 towns got all split up and redone. And so we have areas that we went from publishing 13 areas to publishing 42 areas. And we have all these areas that are at the cap and floor because of this. And it's going to take a few years for this to normalize, because we have some areas that went from kind of a lower income grouping to a higher income grouping. And when they moved up there, they're capped at 9%, but without that, they'd be at 30%, right? So it's going to take a couple of years for them to normalize, and we have the vice versa. So Connecticut, this is going to have some longer reaching impact. But again, I think the takeaway from this is this isn't going to happen in California next year. It happened because Connecticut changed how they did it. And I think if you're in New England, you have some concern because Massachusetts has talked about this before, other states. And so, but you'll know about this when this happens because it's going to be a big deal in your state. And then you'll have to kind of be bracing yourself for this change to come.
And when you mentioned this about Connecticut, I mean, it strikes me that every investor, every syndicator with properties in Connecticut should be looking at the various properties they have, because it seems like those where where you had a dramatic increase in the income limit. For instance, this is existing properties, right? You're just,
right.
I'm thinking, we're on this, whatever, this annual growth and all the rest. They could have properties where the rent increases are like going to be at the max for a while to sort of catch up, if you will, which means, as you're trying to qualify new tenants, it could be a little bit more challenging to qualify new tenants. And then you have other properties where, the rent growth is going to be low until it normalizes back to what that area is. But something tells me operating expenses isn't going to be normalized. So from an underwriting perspective, for even an asset management perspective for those properties, there could be some areas where individual properties have notable challenges. Am I capturing it right? Or how would you?
Yeah.
Bob McClank coming to you with that observation. What do you say?
Yeah, I'd say, we got to look at your area and understand what's happening here, because this is a little different in the caps in the sense that you've moved into a new area that kind of has established income limits.
Right.
And you can kind of know this cap is a little more banked than you might know if it was just your one county that's going up and down. And so we should be talking about that, talking about these increases that you're going to see. And I think really making a strategy how you're going to implement the rents over time, right? Again, I'm a big proponent of not increasing rents by 10% a year. And so creating a strategy how you're going to do that. What's interesting though on the tenant qualification is your city didn't change, right? So your residents, it's just you're on a new grouping. So maybe you were having issues qualifying before, and now it might be easier, is another kind of interesting piece of this. And then the ones with decreases, this is the one that you really need to kind of be looking at and planning for. And unfortunately, as many times as you try, if you send your insurance adjuster or anybody else a note that says my income limits are held harmless, so my expenses have to be held harmless, they don't listen to that. They don't respect these letters I write. So, you're going to have some pressure. So you need to think about, do we have sufficient reserves? What are we doing about this? And especially if you're looking at a new project there, you really need to be focused on it. And we won't talk about it here, but you need to focus on your gross rent floor election. You need to be focused on what are your underwriting assumptions, and are these deals even still feasible? And really be taking a hard look at your portfolio. And this is in Connecticut, right? We're not saying everywhere. I mean, this is true everywhere, but particularly Connecticut, it's really critical that you understand exactly what's happening with your individual area.
No, it just seems like it can be that given the manner in which the changes were generated, you could have more extreme results.
Yeah.
I've got to believe that, among our listener and viewing audience, that there were some with investments that they were planning on making in Connecticut that suddenly got a shock.
Right.
Their underwriting rents need to be, and are now dealing with additional financing gaps that they weren't anticipating.
Yeah.
This has been great. And I now have a question from What Have You Done For Me Lately department. So now that we look at these rented income limits, they're now out and they're rolling out to individual properties, rolling into projections for new developments and underwriting and all the rest. Now we're looking at 2026. For those in the audience that use the rent income limit estimator as a way to get a sense as to what rent and income limits are likely to be over the next 2 years, what are some of the key points in terms of when that'll get updated based upon data releases from the various sources that HUD uses to calculate the rents? And HUD doesn't calculate rents.
I feel a little bit like Jackson Brown on this question. Let me stay just a little bit longer in 2025 and still processing. But I think it's always good to be forward looking, right? And so we have a couple important data points that are coming out. First, that American Community Survey data, as I mentioned before, will come out in September. And that's really when we do our first big update of the estimator for 2026. And that's when we can start estimating all the 1-year areas. Fair market rents also come out then. So we can start estimating for these high housing cost areas. And so for a vast majority of the country, we'll be able to tell what 2026 income limits will be with a high degree of, I don't want to say certainty, but with a very high level of accuracy, unless that changes their methodology again, of course. And so we'll know that in September, but I'd like to get a little hint on that. So if we look at the CBO estimate of wages, right, they're anticipating that, well, we look at our trend factor, right? The wage data from CBO is saying wages are growing by about 4% a year on average from 23 to 25. So maybe our ECS data, we can put a 4% hold in there for now for an early estimate. We'll know more in September, but I kind of see what our magnitude is. So I kind of put a 4% hold there. And then the CBO inflation factor that changed, that's going to be updated in August and January. So after that comes out in August, we'll have a better idea of what we think that inflation factor is going to be. And it'll come out again next January, which will be the final one they use. But if we look at that CBO inflation factor right now, right, because we have their estimate of it today, obviously that's going to change by next year at this time. But their estimate today shows that inflation factor is slowing down. So as we talked about, a slower inflation factor results in kind of this headwind for income limits. So if that's slowing down, And it looks like it's somewhere between 2 to 3% slower this year. So we say that income's going maybe at 4%, but our inflation factor is slower by about 2%. So right now, and again, this is very, very early, so don't take this to the bank, but we're kind of looking at very kind of anemic growth for 2026, potentially based on what we know now. And that's subject to change, right? We don't really have any hard data yet. We have a bunch of estimates. But of course, come September, we'll start to really get our estimator updated. We'll start to really have some really kind of hard data we can use to inform that. And now kind of reflecting back on 2025, of course, our rent income limit calculator is up and running. It was redesigned this year, hopefully to be more user-friendly with the ability to export to Excel and do some things that people have been asking for. And so we're kind of getting ready for next year. The first thing you need to do is make sure you've implemented the limits for this year. And so, use the rent income limit calculator and be, getting yourself familiar with that estimator that you can purchase for individual counties.
I would just emphasize when you mentioned the anemic growth based upon what we know now and subject to change and all the caveats around that, that anemic growth is the average. And as you talked about with all the capped areas and all the rest, individual results will vary. They can't vary dramatically, which is one of the reasons why so many clients go to you for the rent and income limit estimator, so they can know what directionally a better sense of what would happen on their individual properties.
That's a great point. I think that 2026 might look a lot like 2024 did, where we have kind of very slow growth in AMI. I think it was around 2%, but our VLI still was growing around 5% because of these capped areas, because of high housing costs and other things. So, right, individual areas are going to vary.
Now, I'd be remiss, and I'm sure many in the audience are thinking of this, the next question, in some way that's reflective of a podcast that I did with, or the theme of a podcast I did with our partner, Rich Larson, and our Chief Public Policy Officer, Peter Lawrence, earlier in the year, which is our most popular podcast sort of all time at over 13,000 plus, and maybe more by now, downloads. And it was dealing with DOGE and HUD and various sort of cuts, which obviously is of broad interest throughout the affordable housing community and beyond. But I want to do a more targeted question here. And not that that's the standard for how popular I expect this podcast to be, but everyone's got to be thinking, we have a new Trump administration. The income limits did come out on April 1st, even though oftentimes there's a change of administration, there's a delay. What are you anticipating in terms of possible changes with the new Trump administration with respect to income limits?
So I want to kind of ease people's concern to say I'm not anticipating any changes, but let's talk about why. So number one, they just changed that trend factor. So when you look at income limits, there's kind of two main inputs, American Community Survey data and the trend factor. And I don't really see them change any of those right now. And when HUD joined our income limits working group a couple weeks ago, and in the briefing material, they said that they plan to use this trend factor going forward. So I don't see any tweaks there. I could see some tweaks as on the fringes. I could see the administration doing away with, for example, the cap or the ceiling on the cap, right? I could see tweaks like that on the fringes that would kind of help kind of be more pro-business, if you will. And so that's why I would potentially see something. But based on kind of the feedback I've been getting from HUD and kind of looking at things, I don't see any tweaks there. Where I do have concern is with potential staffing cuts. And if there are staffing cuts to HUD, how does that impact the timing of the release of the data? And if there's staffing cuts at other agencies, the one area I'm concerned about right now is the extremely low income limit, which is used for housing trust fund dollars and some other things. Is there's some data we need from the Health and Human Services Department, and there's been a lot of cuts there. So is that data going to come out on time? If it doesn't, does that delay limits? So I think I'm more worried about delays than I am worried about change in methodology.
That's an important point about the staffing, because I shared a bit of concern, or at least trepidation, as to how staffing cuts at HUD might end up impacting the release of the income limits. And fortunately, it didn't.
Right.
And hopefully, we do a good job of communicating to HUD the importance of the income limits and that as they're looking at staffing cuts and reductions in force and the rest, that this isn't an area they look to. Other than, it's all about, I'm all about making things more efficient and all the rest. If there's ways to make it more efficient, that would be good. We're all for greater efficiency, but we don't want it to result in delays. So I'll bring this to a close, Thomas, but before I bring it to a full close, I did want to ask you about other resources that you think it's important for our audience to know about. We've already covered the rent and income limit calculator tool that's on the website, and as you know, it's been updated. We've talked about the rent and income limit estimator. I mentioned our upcoming monthly tax credit conference in San Francisco on May 8th and 9th, and I hope many of our audience will join us. I always enjoy meeting our audience in person. And then I also mentioned the income limits working group, but maybe you could share a little bit more about, and you made reference to the income limits working group, maybe as part of additional resources, you could talk about the income limits working group and any other tools that you think are useful.
So first off, I will mention I will be at our conference in San Francisco. So if you do want to pick my brain, that's a great time to find me between sessions. But the income limits working group is a great group. And what we do is it really should maybe be changed to HUD working group, but then people might confuse it with HUD financial statement. So we've left it income limits working group, but we do really kind of focus on any sort of HUD data that comes out. And HUD has been very great about joining our group. They've responded to our comment letters we've submitted. And we've really, as a group, we've examined closely the changes that HUD has anticipated. If we look back, there's been some big changes to fair market rents, et cetera. So the working group kind of tries to be a group that looks at issues with income limits and submits comment letters on those, and hopefully tries to drive the process and to get good results. And it's not just HUD. We also sent a comment letter to Treasury about how they implement hold harmless, because we think there's some technical fixes there. So really technical issue related to income limits. We're trying to be on top of that and respond to that. And we have these meetings where we kind of come together and we share ideas and talk through different income limit issues. And it's been a great group to be a part of. And we have a lot of really strong members. So if that's something that interests you, highly recommend you join. And then one other thing I'll mention is we do continue to have our free rent income limit calculator, but we have what we call our enhanced rent income limit calculator. So as you know, when you're calculating income limits, you have to know when your project's placed in service. You have to know unit mix. You have to know all this various information. And every year when you want to update your table, you have to put all that in again. What the enhanced calculator does is it allows you to put that in once and save it. And then the next year when income limits come out, you just go in and say, oh, I want 2026 and click on it's there. Or you have an issue that comes up and you want to figure out what the income limits were in 2022. You just go to your menu and you click on 2022 for that property and it spits it out for you. And it makes it easy so you're not redoing all this data input every year. And that's the whole gist of it. We'll still continue to have a free calculator. We think that's important for the industry. It's widely used. But for those who want a little more power usage, that's what the enhanced calculator is for.
Thank you for that, Thomas. And thank you for your leadership with the income limits working group. I do feel like that was an area, and I've said this before on the podcast to you and with other guests, that it is one of those areas where I do feel like the industry was a bit late in arriving at the importance of interacting with HUD with respect to these calculations. And I say that in part because it's an area that affects every single, a lot of the tax credit finance properties and so much more that, and HUD does, talk about upcoming changes and things of that nature. And I do feel like in the past, there were known changes coming that because of a lack of attention to the guidance HUD was issuing, those items weren't incorporated into underwriting, things of that nature. And personally, I've seen, individual developers, end up pursuing a property where there was guidance from HUD that basically said, this is going to be different in like 2 years or a year or something. And it could have been anticipated, but because there wasn't enough attention paid to them, as well as, interacting with HUD as they're making these various changes, to have a dialogue so that the income limits that do come out aren't sort of a surprise or divert short dramatically. So thank you for all of your leadership there. And I'll note that there are monthly calls, and there's a lot more involved in the income limits working group, but I encourage the audience to become a member. And with that, plug. I note that I will link to all these various items in today's show notes. And if there's something that we talked about in the course of the podcast that doesn't end up getting into the show notes, just send an email to cpas@novoco.com and we'll get it into the show notes. And then before we do get to the off mic section, I do want to encourage our audience to subscribe to the podcast if you don't already. And if you're watching on YouTube, I'd encourage you to like and comment on the podcast. If you like and comment it, it helps raise the visibility of the podcast so others in the affordable housing, tax credit, and broader community can hear about the podcast and become listeners and viewers. I also encourage you to share the podcast with your colleagues. It's a great way to get them started on topics, obviously, such as the long-term tax credit and income limits and other of the many incentives that we cover. And we do also have various series, one on renewable energy finance, one on long-term housing, that can, for someone new starting at your firm or someone, I think, I've even had people who are interviewing for a job in this area. They're like, I'm going to go and binge watch a few of these podcasts so that I'm a little bit more knowledgeable when I go in for an interview. But for new hires and the rest, it can be a great way to get started. And then we do have a full archive of episodes if particular topics you're interested in. If you go to the archive and search, you might find if there's an area that you're working in and not that experienced with, that we have a podcast on that. And with that, let me now turn to our off mic section. And as our regular or at least periodic audience members know, this is a section that Tony Grapponi initiated as a guest many, many episodes ago, where the guest gets to give a shout out to someone or someones working in the areas where we at Novogradac work to highlight a professional that deserve particular recognition. So Thomas, who would you like to give a shout out to?
I want to give a shout out to property managers. Because right now they're kind of at the front line of implementing these income limits. And, they often say defense wins championships. And I'm not sure that would make me want to trade Luka for Anthony Davis, but that's a different point. But these property managers are kind of your frontline defense for property compliance, and they are implementing these new income and rent limits, and they're understanding this very complicated infrastructure where you have place and service dates, you have hold harmless, here is special, all these things that they're having to do. And right now, it's their busy time as they're trying to implement these income limits and qualify tenants and lease up properties. So I want to give a shout out to property managers for all the hard work that they're doing right now in implementing these income limits.
Great. Thank you for that, Thomas. And I echo that shout out. They truly are on the front lines and are critical in so many ways, the rent and income limits being just one of them. And thank you, Thomas, for being on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.